Traders, welcome back to another edition of Institutional Sundays. Don't think it's too far-fetched for me to say. Probably the best trading video on YouTube, right? And I challenge you to find a better one, okay? Not only will you be getting to see, well, you see my live fills, etc., but in-depth analysis, okay? No regurgitated crap. These are my own thoughts, and I use them and I put money behind them every single day, as everyone knows. Got an amazing Institutional Sunday session for you and today, well worth watching. You can see this chart, very interesting, right? Put it together myself, all these little boxes. Thought that was pretty cool. Bit more of that chart, right? Really exciting, definitely worth sticking around for. Calendar, last week's calendar. GDP, Fomc statement we're going to have a look at very briefly. More GDP data. Economic calendar for this week, very interesting. Got payrolls coming up this Friday, which is going to be big. Bit more data on the payrolls, kind of what to expect. And then, if I get a chance, performance review of July. Okay, looking at my statistics for this month. Everything shown, my live account. If you follow me on Instagram, every single trade was shown. So we'll go through that anyway. I mean, P&L doesn't really matter. It does to an extent, but it's more about the risk statistics. So I just wanted to jump ahead, just so you know. An action-packed Institutional Sunday today. I actually want to try and get it done in less than 20-30 minutes. And as you can see, there's so much to go through. So unlike edition 1, where I went into a lot of detail about why I'm doing these Institutional Sundays, today we're going to get straight into it. So like I said, week in review. Okay, last week on Monday, in fact, what we'll do is we'll look at this chart in a second because you saw it's on the next page. If you like this sort of stuff, I always forget and I end up saying it quite late. Like and subscribe, right? Don't forget, subscribe to the channel. As you can see now, you've got 2 Institutional Sundays, a little bit of a miracle going on here, given how busy I am with obviously trading. As you know, I'm a full-time institutional trader, so it takes time for me to put these videos together, and I like to give it kind of detail because I don't like to put anything out that is not up to scratch. So I do put a lot of time into this. So if you like this stuff, subscribe to the channel and obviously you'll be getting more of it. So we're going to talk about that in just a second. We're going to talk about market positioning and then the week ahead, like I said. And if we get a chance to do a review, might split the review out into a separate video. But let's get on with it. So what's been going on the last week? If you remember, Institutional Sundays 1 last Monday, we talked about new home sales data, which had come out, was very, very weak, wasn't it? I think it was 675,000. Let me just have a double check because I had written it down. 676,000. So actually what it is, I've taken it off the main calendar because it wasn't marked as a high impact event. But I mean, you can see the market didn't really react to it, even though it was a very negative number on an annualized basis. I think what it is with housing is obviously, it was the lowest number since I think 2019 sometime. So since the pandemic started. So there's all this stuff out there about the housing market boom in the US and being over now. But you know what? It's the first kind of number that's come out that's been quite weak. So let's see what happens. And I think the market was thinking the same thing, right? So 676,000 on an annualized basis. So 676,000 single family homes sold on an annualized basis. So this was released last week in July for June. Okay, so let's see what July's number is. I think the market shrugged it off. We talked about this in the last Institutional Sunday that is telling, that even weak data, when the market is getting data that isn't weak, when the market's getting data that is weak, is shrugging it off. Okay, so kind of shrugged it off, let's be honest. I think what it was is the market had an eye on the FOMC, which we talked about and we're going to talk about today. Tuesday was fairly interesting. We had a very strong consumer confidence number. So I'm going to be flicking back and forward a little bit. So yeah, consumer confidence number there, you can see 129.1 on the index. Slightly below forecast, but higher than previous. So still a very strong number. Showing high consumer confidence. The market actually didn't pay much attention to it. Okay, what actually happened, I think, is that there was a sell-off in the Chinese equity markets on Tuesday evening. Okay, won't necessarily get into the detail, but due to some political positioning from the Chinese government, and basically Chinese stocks sold off. And as you can see, coming into the overnight session and into the open, that really had an impact on markets. Having said that, we were at virtually all-time highs. Market probably used that as a reason to take some profits off the table, but actually there's more to it. Okay, so we're going to talk about Tuesday now in a little bit more detail. So I believe there were earnings on this day from Alphabet, i.e. Google, Amazon, and earnings were so strong this week. Okay, I think it's above 80% of companies beating EPS, which is earnings per share, and revenue, even higher number, beating revenue estimates. And that trend looks like it's going to continue, and we'll see more earnings coming out for the next couple of weeks until it kind of goes dead, like Q2 earnings season reports will pretty much be finishing in a couple of weeks, but expecting pretty much this similar sort of results, where most 85% beating their estimates. So why did the market sell off anyway? This for me was really, really interesting. On Tuesday, we got a sell-off regardless of decent consumer confidence numbers, which to be fair were a little bit later in the day, but also strong earnings. I believe what was happening is, the Chinese equity sell-off had an impact, but also this is what I mean so I'm jumping back and forward a little bit here when I talk about positioning. Okay, so I believe what happened, okay, is the market was positioning ahead of this. Okay, there's a little bit of I think, to be honest, most of the market had kind of come to the conclusion beforehand that the FOMC was not going to be giving any indication about any sort of changes to its loose policy in terms of when it might end its aggressive purchases of treasury securities, mortgage-backed securities, tapering, another word for it. But having said that, naturally, there is risk, right? You're never going to have 0% risk. So obviously the market kind of felt that there was some risk. The context is important. Where are we coming into the FOMC? Well, we're very elevated, right? Almost at all-time highs. It made no sense for the market to be rallying ahead of this number, given where we were. If the market was very depressed, we might have seen a rally going into it, but I believe a lot of what happened on Tuesday was positioning, where people just took some positions off, lightened up ahead of the release, and that's what caused the sell-off on Tuesday. Okay, so a couple of factors there. Foreign markets, you can see, quite important. Chinese market had an impact, but also despite strong earnings and strong data on this day, we still had a sell-off because I believe people were positioning ahead of the FOMC. And then on the day of the FOMC, we did get a little bit of a spike lower, but that was probably more down to a thin market, okay, around the time of releases. Talk about that in another session. I don't know if you guys have used the depth of market before, okay, where you've got prices. If you're not using it, you really should be using it. How do you trade without knowing where people are buying and selling? Okay, depth of market tells you how many bids and offers are in the market. Okay, and let's say for the S&P and the futures market, in the past we've had 2,000-3,000 contracts either side, but more recently it's a lot thinner than that. Partly because the market has been trading a bigger range, so there's more prices for contracts to spread over. So obviously the contract sizes or quantities at each bid and offer are going to come down. A lot of this is explained in the G7FX and Pro and Foundation courses, but bids and offers, let's say they're at 200. Just giving you an example, just to kind of put things into practice or to bring this alive for you. So talking of 200, typically going into that number, that is just going to go to virtually nothing, right? Maybe 5 even. So it's going to cause a lot of volatility, whipsawing when the actual statement is released from the FMC. And we're actually going to talk about the statement in just a moment. You can see it here, Federal Reserve statement, we'll talk about in a second. But yeah, market kind of, it was a relief rally in my opinion, a relief rally. Okay, it's not like it was positive news coming out of it, but maybe the market was happy that it wasn't negative either. Do you see what I mean? There was a bit of relief coming out of it. Then coming into Thursday, obviously the market was expecting a very strong GDP number, but my understanding is that the market actually rallied because there was a bill, an infrastructure bill passed in Senate. So I've taken that off, infrastructure bill. Okay, where the government is put together, it's a procedural bill, so obviously it still has to go through various stages in the House, which is probably why we didn't get much follow through into the next day. Basically, they've proposed, the government have proposed putting, is it 550? I've written it down here. Yeah, $550 billion into building infrastructure, etc. So obviously that will hopefully give a little boost to the economy. I believe it's the first time that the US has put together such a proposal for quite a while, especially of this size. So kind of gave a boost to the market. But like I said, it's not being passed. It's just a procedural bill, and it's got many stages to get through before it gets signed off in the House. So whilst it gave that initial boost, we did get a sell-off the next day where we gapped lower. And I don't actually think it's because this GDP number came in at, we're going to look at it in a second, I believe it was 6.5% instead of the 8.5%. So you can see it here, GDP, yeah, 6.5% instead of 8.5%. So actually I don't think the sell-off was because we missed the number here, because actually we were up on the day. Okay, so we still had a positive day. The GDP number at plus 6.5% was actually very positive, I think, when you actually break it apart, because one of the reasons that GDP came in slightly under, it was nothing to do with consumer spending. It was more to do with lack of inventories. There just wasn't enough stuff for people to buy. So that's not a bad thing, is it? And I believe that's how the street read it as well, because obviously I do a little bit of research ahead of putting these videos together, and things I was reading generally had the similar sort of sentiment. We're going to talk about that in a second. Inflation, which is the core PCE, came in at 0.4% versus 0.6%. So market didn't really seem to react too much to that. So you can see it was kind of a flattish day on the Friday. I don't think the market was really paying much attention to this core PCE number, which came in slightly softer but still elevated at 0.4%. So it's still quite high, the inflation rate, and that'll be interesting to see. We talked about it last week. The Fed keeps referring to it as transient. So I believe if you look at the statement, which we're going to come back to in a second, is it here? Inflation has risen, largely reflecting transitory factors. Sorry, that's what I meant, transitory. So temporary things. For example, obviously the supply side issues, inventory issues, which we see here, okay, in the GDP number as well. And that's what's causing prices to go higher, right? If there isn't enough stuff to buy and everyone wants to buy it, what's going to happen? The price is going to go up. Simple as that, okay? Simple supply and demand. So that does remain elevated, okay? So that's your week. So to kind of summarize, let's summarize. Quite a mixed week last week, right? End of July. last week of July, a kind of a mixed bag, right? Let's just summarize kind of what we saw. Earnings, the market kind of shrugged off because we've had so many strong earnings reports. It wasn't really a surprise, right? When earnings keep beating estimates, the market's like, yeah, okay, all right, we get it, fine. So Monday was kind of a nothing day, right? Market kind of was just drifting, you could say. Tuesday we had the sell-off, kind of a mixed bag. You obviously had the Chinese equity sell-off overnight, which didn't help things, but I actually think it was accelerated because of the FOMC. We then had a relief rally because of the FOMC. We had an infrastructure bill announced, procedural bill that the US government is going to be spending about 550 billion on projects, variety of projects, building projects, right? Building infrastructure, motorways or whatever, right? A bunch of things. Haven't necessarily looked at the detail of that. Kind of irrelevant to my trading, but good to know. Then we had the GDP, which I believe was quite positive and kept the market quite elevated. But then I think the market, well, from what I read, because it was a procedural bill, and obviously the market kind of came to the realization that it may take a while to push through, market started to come off, okay, overnight. So we had a little gap and a sell-off. But to be honest, we went to all-time highs, and I think the market kind of just ran out of steam. Let's be honest, right? Very mixed week, right? Very up and down week. Very rangy week. I think the market literally just ran out of steam on Thursday. Like I said, this was more a relief rally. It's not like we had some incredibly positive statement where we could get follow through. The GDP number was solid. It wasn't spectacular. So again, the market kind of was happy with it, don't get me wrong, but there wasn't really the impetus to see any follow through, right? So it was very much a mixed positive week, but generally nothing new, right? And nothing that, no surprises. Do you see what I mean? No big surprises, nothing new, kind of a generally okay week, and that's how the market traded, right? So no big surprise there. The coming week will be very interesting. Let's just quickly tick these off. Okay, this was last week. So as we said, the home sales, I haven't put it there. Okay, but this will be very interesting. New home sales. Let's see if this is a new phenomenon now, where not a new phenomenon, but a new trend, right? Where we start to see these elevated home sales numbers on an annualized basis coming off. Let's see. That'll be very interesting. So we'll keep an eye on that this month. Consumer confidence. Market shrugged it off. Obviously had a lot of other stuff to deal with on this day with the Chinese news and I've forgotten the other thing that there was. What was the other thing? Earnings and positioning ahead of the FOMC, which was the next day. Right, FOMC we're going to cover in a second. I'll be honest with you, nothing new, just a relief rally. But we will talk about that in a second. GDP was interesting. We talked about that already. And then inflation, still quite punchy, slightly less than the 0.6 expected, but still very punchy. So we've covered the week in detail. I talked about it here on this graph. Let's now go into a couple of those pieces of data that we've just covered. The two most interesting pieces, right, from last week. So FOMC in the middle of the week, which was really sandwiched and between obviously things going on at the start of the week in terms of earnings, and then a sandwich between things going on later in the week, like GDP. So it's bang in the middle of the week. What do we think about the FOMC statement? So, I mean, won't necessarily read it out loud here, but let's see what they were saying. Inflation has risen, largely reflecting transitory factors. Okay, nothing new. They've been saying this for a while, that they believe that inflation is. So what it is, when inflation is elevated, right, typically you'd expect a hawkish or a aggressive central bank that wants to put interest rates up to bring inflation down. The reason they're signaling to the market that it's transitory is because they have loose policy. So they want the market to continue to feel comfortable that they will continue having loose policy. And that basically they're signaling to the market, we're not concerned about elevated inflation. So the market shouldn't be either. So something to keep an eye on, right? Could look at it the other way, that if inflation starts staying elevated and it isn't transitory, over the next few months, if inflation doesn't come off as inventory starts to build up again, that could be a problem for the Fed, right? Wanting to keep loose policy. So that would be very, very interesting. But for the moment, no change in language. Overall financial conditions remain accommodative, in part reflecting policy measures to support the economy and flow of credit. So again, nothing new there. Part of the economy continues to depend on the course of the virus. Vaccinations will likely to continue to reduce the effects of the public health crisis on the economy. But risks remain. So really, to me, it sounds like the Fed themselves are quite confused. Okay, they don't know exactly what they want to do. They're going to wait and see. It feels to me like they're very much in wait and see mode. Okay, you can see it there. They're really not giving anything away. They're leaving it very open to people to debate, right? So clearly they're waiting to see what happens with the impact of the vaccinations. I actually think what they're hinting at here is they want to see what the take-up of jobs is like, okay? And we're going to talk about that in a second, about this Friday's jobs report, because it's one of the things. The unemployment rate has stayed not elevated, but it started to level off. It hasn't continued to be pushed down. And I think that's one of the things that they want to see, because that will give them a clue as to the impact of this progress on vaccinations, right? Progress on vaccinations, and also here in terms of the risks to the economic outlook, course of the virus, okay? In terms of people getting back out into the workplace, and also companies feeling comfortable taking on new staff. And actually the second part of it seems to be much less of an issue. Even here in the UK, there seems to be plenty of jobs. It's just people aren't feeling confident about going back out there and taking jobs until they feel comfortable that the risk of them getting infected and potentially obviously death is minimized, and the vaccination will help that. So that's why they talk a lot about progress on vaccinations. We're going to talk about that in a second, and I think a lot of that will be reflected in people taking up jobs, inventories building again, and those are the type of things I think the market are going to be focusing on, and that's why this Friday is really, really important. And to that point, a lot of what I say may seem like it's all over the place, as in I'm talking about the Fomc statement here, I'm talking about GDP here, I'm talking about the labour market. It's all interlinked, okay? Everything is interlinked. We can see here, I thought this was quite interesting, that even though we only had a 6.5% increase in, well, I say only, still a big jump in GDP, okay, which still took it above where we were pre-pandemic. So let me just show you that. Okay, so there you can see. Okay, above where we were pre-pandemic, just above the $19 trillion mark. Okay, so we still above 0.8% from the last peak. So not a bad number really, right? So even though it was 6.5%, 2% less than forecast. Why was that? Well, we can have a look here. Okay, it was to do with inventories, right? Inventories down. Inventories really took a hit because people just haven't had the numbers, right? Companies haven't had the numbers of employees or confidence to build a lot of that inventory back up, haven't been able to get the raw materials, and variety of factors. We know supply bottlenecks have been occurring because of COVID. So many factors. So actually it's quite a positive that it was inventories that contributed negatively in terms of a lack of build-up of inventories, because what should happen is it should swing the other way, okay? What was really interesting is this shift away from durables consumption to services consumption, okay? And that suggests more confidence building amongst the consumer to go out there and use in-person services, okay? You can go and look this up. I'm not going to get into detail, but ISM services, okay, will give you some of the type of services that people are now feeling more comfortable going out there and actually participating in because they feel more comfortable now that the vaccinations are around. So that all bodes well, I think, for further expansion. Obviously not at the kind of pace we've been seeing recently, 6.5%. I believe the forecast for H2 are slightly lower, maybe 4%, and then going into H1 2022, I can't remember the number, maybe similar, 3% to 4%, I think it's around 4%. Okay, so keep an eye on those forecasts for GDP as Institutional Sundays develops, but hopefully that was useful for you. Nothing new in the statement, in the FOMC statement. We'll see if there's anything in the next couple of months. This week's jobs number, which is what I want to talk about next, pretty much covered last week extensively, okay? This week, today is actually Monday. We've already had some trading, and I did trade today, okay? I'll show you my live account as I always do. The ISM manufacturing number, I've talked about this. They're already elevated numbers, way above 50, at 60. There's obviously a lot of consumer demand around at the moment. We saw that in the GDP number. So manufacturers are buoyant, essentially. So no surprise to see the survey coming back at such high readings. I don't think the market is really paying much attention to these surveys at the moment. Like I said, the services and PMI as well. This shift towards services from consumers as well, reflecting in the plus 60 number. So I don't think the market is really focusing on these numbers. So I really think this whole week is going to be a bit of a muted, at least as far as economic data is concerned. We may see some interesting action on Thursday ahead of Thursday, okay, ahead of this number. Okay, I think the entire market is watching this. Like I said, it's kind of not the only, but it's kind of one of the things that I think the market is leaning on as to why the Federal Reserve is still being so accommodative in terms of policy. Maybe not being so accommodative, but the lack of messages coming out from the FOMC about why or when they're likely to take their foot off the gas when it comes to some of these purchases of mortgage securities and treasury securities, which obviously keeps the rates low, right? It's the mechanism they're using to keep interest rates very low. So this will be very interesting because it has been kind of stagnating at 5.9%, right? The unemployment rate. We're expected to have quite a punchy non-farm employment change, okay, at 900,000. The final thing I want to say, right, the reason why I think this is going to be really interesting, it's going to be so interesting to see how the market reacts to this number, because there's two ways it could go, right? Either you could argue that, strong jobs number, okay, which is what is expected, looking for it to go down 20 basis points to 5.7% unemployment rate. That is obviously going to have a positive effect on the economy, right? And also inventories If more people are taking jobs, it will enable the kind of bottleneck problems that a lot of companies have in terms of their inventories and stocks, and helping them to rebuild those stocks, and therefore that's going to provide another boost to GDP. So I think it's going to be interesting whether the market sees that as positive, because the other way to look at it is, if this jobs number comes in strong and then strong again, because I don't think the Federal Reserve or the FOMC will necessarily give much away again in August. I think September, they'll have had 2 more jobs reports by then, so they'll be able to watch this unemployment rate. Does it start to tick down? If it starts to tick down, and inflation stays elevated, or things start to get overheated in terms of projected GDP growth rates, and they're almost forced to kind of move the dial in terms of interest rates, right? What's been driving the equity market recently? It is loose monetary policy. As soon as any indication comes from the Federal Reserve, right, I don't think they'll do it in a sudden manner. They'll do it slowly. They'll signal to the market that they're going to be maybe having a little shift in language. But if they do that, is the equity market going to think, right, okay, the good days of easy money are over? We could see quite a hefty correction in the equity market. Now, I'm not saying go out and sell it. I'm just saying it will be interesting to see how the market takes this number. Okay, my opinion is, if it's a strong number, the market's going to be happy anyway. So either way, I think this is going to be taken positively. The initial reaction may not be that way, but I think ultimately, even if we do get a big sell-off on Friday, for example, I think come the following week, the market, once it digests the number, will be I think it'll be a positive overall. So that'll be quite interesting. Like I say, you can kind of tell I'm in 2 minds about it, but I feel like it will be positive either way. I think it's a positive thing. So I think once the market gets over any sort of initial fears it might have about tapering, that the market will take that positively. But we'll wait and see. Point is, I've talked a lot, but it is all about Friday this week. That's what I'll be focusing on. One final thing before we wrap up. So this is very interesting in terms of job openings. So you can see companies are getting very aggressive, okay, in terms of job openings inverted, right, versus the unemployment rate. And yeah, highly correlated, obviously, right, to the unemployment rate. So we can see job openings are now starting to scream ahead, right? Companies are desperate to hire staff. We know that. It's all about whether consumers are confident enough to start taking some of these jobs, getting back out there with the vaccinations and so on and so forth. So let's see what happens. Very, very interesting number. Hopefully that's useful. Lots to look forward to, guys, this week. I did do a little bit of trading today. What I'm going to do, I've just realized, because I did want to do a July performance review, but the video's gone on much longer than I wanted it to. So you can see my performance last month. Not too fussed about the P&L, but you can see here some of the stats: average daily gain and loss, average winning trade, average losing trade. But you've got to compare the MAE versus that. I just don't want to get into a lot, because I could talk for 20 minutes about this. Let's put this aside. Let me quickly show you what I was doing today, get onto the charts, and then call it quits. Hopefully that was a useful Institutional Sundays version 2 for you. Hopefully that's given you something to think about this week. Any questions, let me know. Let's get on the charts and then wrap it up. Okay guys, here we are on the charts today, Monday. You can see here, let me just open it up for you. Okay, today about $600 today, just a very rotational day, so you can actually see my order fills. There you go. Okay. Now, I'm not going to get into detail on this because I do want to wrap up the video, but ultimately we have had kind of, if you think about it, right? So if you think about Monday, Tuesday, do you remember what I talked about? Wednesday, Thursday, Friday, exactly what I talked about at the start of the video. Okay, so we had the sell-off based on the Chinese equity market sell-off here on the Tuesday. On the Wednesday, we came back on the relief rally, FOMC. Okay, this was the positioning ahead of the FOMC. This was the GDP and the infrastructure. I'm going to put fiscal, which is basically political policy, right? So the government policy about the infrastructure projects. And then coming into Friday, we obviously had a bit of a pullback. You can see why. We're just coming back into where the market was happy. Today we opened up out of it. So I wouldn't say bullish, but like I said, I expected the data not to have an impact. And it didn't, right? The data was released at 10 o'clock today, the ISM number, somewhere in there. So you can see it didn't have much of an impact. I was definitely looking for some sort of kind of range movement, okay? So you can see a lot of rotational type of trading from me today, right? Bit of up, bit of down, not much certainty, didn't know what I wanted to really do. So yeah, hopefully you can see that. All my fills, every single fill there, you can see it. I kind of started the day with just playing this range and then took it short initially, went long, and then that was it. And then pretty much gave up, right, in this region. You know, when I started thinking about, okay, what's the market likely to do today? Probably not very much. Okay, it was very, very slow. And obviously people like me who had expected the market to go up today eventually gave up. So that's why we see the sell-off. So anyway, it will be very interesting, I think, this week, like I said, going into Friday, right? You know, if the market holds this region here and we start to build some volume above going into Friday, we could well see a big sell-off. Be very interesting, this region, I think, to see what happens. You know, if we start to break down, market could be in big trouble. Let's see what happens. Sorry I didn't get a chance to do the July review. Already went on much longer than I wanted. Hopefully that was really useful for you. Don't forget, check out G7FX freetraining.com if you like this sort of analysis. You know, if you're fed up of watching people flying around in Lamborghinis that they don't really own, let's be honest, and you want to kind of listen to some proper stuff, right? This is how it's really done, then by all means feel free to check out the training. Hopefully you enjoyed the video. Don't forget to like and subscribe. Have a great day. Really excited for the next Institutional Sundays, and thanks for watching. See you later, guys.